There's a sale on stocks today. It's a 20% off sale. Let me tell you why I think that. So it's a 20% off sale. What I'm going to talk to you about today is we're halfway through 2022. Where are we? What's going on? I know this is a bit of a big picture video this week. Last week I had a very detailed one on inflation and what's all going on with markets, but here it's more of the big picture. I'm also going to give you some perspective on bear markets in general and talk about how to be a successful investor. So first of all, now why do I say that this is a buying opportunity? And I'm going to say it because I don't know that that this is the bottom or this is the best time. We got a 20% off sale right now. We might have a 30% off sale in a few months. Who knows? I don't know. All right. So I don't think it's actually worth trying to time the market. I think it's just better to get in. Now, while I have no sense of timing the market, I can't time the market at all. The one thing that I can do is recognize buying opportunities, which are pretty easy. And so to me, is anytime there's a decline of 20% or more, it's officially called a bear market, and all bear markets are buying opportunities. Now, I've been very lucky in calling these in the past. Today, it's not nearly as severe as past times, so good chance I'm wrong on the timing this time. But so March 2009, I don't know if you remember that. That was after the big the financial crisis. So there, the market was down over 40%, and it felt like the world was going to come to an end. I have an article on my blog called "Irrational Pessimism, March 2009, and I said this is probably the best buying opportunity of your life, and that was the bottom of the month of the market, and we had a 11-year bull market from that month. The other one was March 2020. When COVID first happened, remember the market was down 35% in a month and it recovered in just 6 weeks. So March 2020, again, while it was plunging, I thought this is just way too much. It's way overly done. And you know what? It's either going to be overly done or COVID's going to end one way or another, and this will come back. So I thought it was an obvious, really good buying opportunity. So now this one today, it's more mild, but it is officially a bear market. So what it is, because I don't know about timing the market, I don't know when it'll recover, but I do know that it will recover, and that's the important thing. And the big thing is, so from here, the only way you can lose money in a bear market, if you're properly invested, is by missing the recovery. So if, let's say, it goes down further, well, that amount will come back as well. However, if from here you sell and get out, or you have money to put in that you don't put in now, and you miss the recovery, well, there's a good chance it's never coming back down to this level again. So that's how you actually lose, missing the recovery. So now, right now, we are down, 18.3 in the US market, 18.6 globally. Canada is actually a little bit less. Now, officially, it's a bear market because we passed a 20% decline from the high of January 3rd, right, beginning of the year, down to June 16th. We made it over 20% decline. So it's officially a bear market, even though we're slightly less than that right now. And this is a picture of bear markets. You see what happens in these. We have them fairly often, not predictable, but it does recover. So on average, a bear market is a bull market. So a definition is a bull market. A bear market is a decline of 20% from top to bottom. The bull market is from the bottom up to the next peak. And a decline of less than 20% is considered to be a continuation of the bull market. So that's how these are officially defined. So a bull market's on average up 130% over 54 months, 4.5 years. And then there's the average bear market is 28% over 9 months. So right now we're down 20% over 6 months. So it's a little bit small of a bear market so far, but may get bigger or it may not. So right now we're in an ordinary bear market. It feels like lots of bad things going on right now, all at once. We got inflation, we got the war, we got the end of COVID, and stuff going on, big government deficits. But overall, it's just an ordinary bear market. So we've had like 10 of these in the last 100 years, and just to give you some perspective. So typically, the market is a bear market at 20%, a decline of between 20 and 30%, happens on average about every 5 years. A little bit bigger ones, 30 to 40% happen about every 15 years. And the ones over 40% happen on average about every 30 years. Now you can't predict them, but I think I'm giving this perspective because I think people think that the market just plunges and you could lose 80% of your value or lose everything, but you can't, because the market does go up over time, but it has declines and they're not insignificant. These are fairly big, but I'm trying to give you a perspective on how often it happens. Now, in the last 20 years, we've had 3 declines, and actually 2 of them were over 40%, and one was in the 30 to 40. Strange, we haven't had a 20 to 30 yet in this last 20-year period. So, but I'm just trying to give you a sense of how it is. Now, the important thing is the market recovers from 100% of declines, and it will recover from this one as well. So this is, market since 1950, and the yellow periods are the bear markets. And notice, even when you fully include the bear markets, if you just ride it all the way up and down, you still get this long-term, 10, 11% return, whatever the market gets long-term. And you very definitely make money, including all the bear markets, and it always recovers. It always has in the past, and I'm sure it will in the future. So, and actually, it tends to recover much quicker than you think. Okay, so here's a little insight into recoveries. So you may have seen things about what happens if you miss the 10 best days or something in the market, and how that affects you. So the problem with all those things is that, see, the best times are almost always right beside the worst times, and it's every time period. So the best day in the market is usually the day right after or right before the worst day. The best week right after that worst week. The worst month, same thing for same with a year. And so I'll give you an example. This is the US stock market 150 years. And let's take a look at, so these are declines over 20%. So those are bear markets. So let's see what happened. Now, what I can tell you is, other than the Great Depression, almost every bear market, every 20% decline, these are calendar year declines, almost every decline, the very next year was a gain of more than 20. You didn't have to wait long. So, for example, so here was a loss back around 1905, it was a loss a little over 20. The very next year, gain of 40, right? So that here, this is the Great Depression. There were 4 down years in a row, including a minus 20 and a minus 40. So when you had to wait a year, so it wasn't immediate. But then right after that, there were 2 gains of almost 60. So that was, the biggest bull market in history was right after the biggest bear market in history, not surprisingly. Then we had a decline of a little over 30. And this is the case. We didn't quite make 20 the next year, but close. Then here we had in the 70s, we had a loss of about 30. The very next year was a gain of 40. Around 2005, or 2002, we had a loss of a little over 20. The very next year was a gain of 30. And then we had a loss in 2008 of almost 40. And next year was a gain of close to 30. So see, it almost always covers real quickly. And if you want to know, if you graph, if you want to know what the recovery is most likely going to look like, it's going to usually look like the mirror picture of the decline. So right now we have a decline that went kind of like this, like start off slow and moderate. So that means the recovery is probably going to go reverse of that. So that's kind of the insight in what's going to happen. Now, you don't know these things for sure, but that's just generally what happens. So now that's 1 year, but see, when you take 25-year periods of time, the market always has done well. 5% a year way back when we had mostly railroad stocks or agricultural stocks. And this is the modern stock market. It's basically always done more than 8% a year in 25-year returns. And it doesn't matter if you start at the worst possible time, just at the top, just at the peak before a big decline, you still get a good rate of return over the long term. And this is the really long term, and this is just to give you that perspective. So this is 200 years of data, and all these numbers are after inflation. And just look at the stock market for a bit. So the yellow is the white is what has actually happened, and the red is the trend line. And you see, it's always been close to that trend line. And I show you this because people think, what happens if the stock market stops being a good investment or something? But this goes back to the Revolutionary War and several previous pandemics when we didn't have vaccines, the 2 great world wars, the Great Depression. So and through all that, it just keeps going along fine because we're invested in companies that grow over time and grow their profits, and that's why it happens. Now, you don't experience it. See, this makes it look extremely smooth, and it's not that smooth. You don't experience it that way because, see, these are decades that you're ahead and behind, and this is, exponential graph. But I'm just trying to make you the point that the stock market is a very reliable long-term investment, not short-term, but long-term. So now we've got the sale going on right now, and it's, it's the overall market's only down 20%, so it's a 20% off sale. So but the way you need to look at it is you're invested in a bunch of companies, is really what the stock market is. You're invested in a bunch of these big companies, and the question is the company actually worth 20% less? Because what happens is, there's trading and people bidding and to buy and sell shares all the time. But meanwhile, the company just kind of running its operations and slowly growing, and it's a bit unusual stuff going on right now. But overall, is your company actually worth 20% less? And very often it's not, and that's how it's going to come back after a while. So now today there are some really cheap companies. Now where it often is in the small companies. So the Russell 3000 is kind of the smallest. It's from the 2000s to the 5000 of the largest company, right? So it's a fairly small companies, and right now 150 out of the 3000, so it's 5% of them, are trading at less than cash. What that means is if the company declared bankruptcy and just handed out the cash to the shareholders, it would be more than the share price is right now. So it could be reasons, but most likely this means that these companies are really undervalued. So, and that's just an example that there are some really undervalued ones. And the big undervalued ones right now are in technology. So, while we had, a huge run up in 2020 with technology, or like the real growth stocks, this year, like while the overall market's down 20, it's the technology, the growth stocks are down quite a lot more. So there are some really good growth opportunities in there. So I know our growth fund manager that we work with says this is the single best buying opportunity of his life in the growth area, the growth investments in technology. It's a much bigger sale than it is with the broad market. So now let's just talk about how to be a successful investor and how to look at things. And the really important thing is the definition of risk. Okay, and this is what you need to be in the right mindset to be an effective investor. And it's important now when we're in a bear market to think this way. So the investment industry, they're all short-term thinkers, right? They're always worried about what's happening next. Are we going to get a recession? Is this the bottom? How do we get to the bottom? And they're always worried about this. And see, they define risk as volatility, investments going up and down. That's how they define volatility. For long-term investors, it's different. So remember, we're the financial planners. We write a financial plan for you. We help you set your life goals like retirement, and then we're thinking long-term. And so the way we define risk is the return that you need for the life that you want. So you have a retirement goal, for example, that says you need to make 7% a year or 8% a year as a long-term return, let's say a 25-year return. Okay, so we define risk as your 25-year return is less than 8% a year. Okay, for example. So if market goes down and comes back up, but it doesn't change our view on the 25-year return, then that's not risk. Okay, that's how we see it. And I can tell you, nothing that's happening today or in 2022 or in the market today has at all changed my view on what our 25-year return is going to be. I still think it's going to be fine, and that's why I'm confident in a recovery. So for long-term investors, volatility is not risk; it's opportunity. And this is actually a really interesting concept, because in the investment industry, they always think of, we have volatility, but you know what? We have these investments that are growing, but let's try to reduce the volatility. If we can reduce volatility, it's better. And I think, is it actually? So this as a concept, let's say that there were two types of toilet paper, all right? And they're essentially this very similar product and similar price, except one of them just goes on sale every once in a while. So would that be good or bad? It means you can get it cheap every once in a while. So, and that's kind of what the stock market is. And if you have a more volatile investment, what it means is every once in a while, like now, there's a buying opportunity. You can stock up and get more of it, and you just get a higher return just because, the way to beat the market is the market's growing, and all you do is you put in a regular amount, except whenever it's down, you just put more in. You bought in low. That alone, you're going to beat the market over the long term. So volatility can be a really good opportunity. So, and the big issue with volatility is that lower volatility almost always means lower long-term returns. So in most cases, for us, we're like, because we're the long-term investors, we're not trying to get a lower volatility if it means our long-term return is going to be lower. I'm more interested in how confident can I be that we're going to get 8% or we're going to beat the market as a long-term return. That's the really important thing. And it's risk tolerant, it's a developing a risk tolerance. You know what? It's a learned skill. And the skill basically is changing their mindset to think long term, define risk properly, and then you can just learn how to stay with the market and take it, and when there's a bear market, don't think of, oh, we're going to panic and sell. Think this is an opportunity. You've got this confidence to stay in long term. So now the secrets to successful investing. This is from a mentor of mine, Nick Murray. Faith, patience, and discipline. So faith is, you just have to have this optimism, and successful investing requires optimism. And to me, optimism is the only realism. It has to be, because if you look back where we were compared to 100 years ago, our life all over the world is immensely better in virtually every way, by a huge amount. Plus, you look at the investments, the stock market has just grown steadily, not steadily, but it's grown hugely over time. And so when you look back, you have to be optimistic long term, and that's what you need, that faith that the market's going down, but we're always optimistic it's going up long term. And the cool part is the progress is linear. It's exponential, right? It's exponential. It keeps growing, and it's being in that. The secret to successful investing is just riding it up and getting this long-term exponential growth. Now, patience is the ability to do nothing, and that's actually right now in the middle of a bear market is actually a really important time to do that. Now, you think the ability to do nothing, well, that's pretty easy. It's a long weekend. I can do nothing. I know how to do nothing, right? But that's, it's because our human gut has taught us over the centuries or millennia to, fight or flight, and that is not a useful skill in investing. You need to be able to stay with it. So right now we're a bear market. You should either stay with it or think of it as an opportunity. Can you take advantage of it in some way? But that's the attitude that makes you a successful investor. So remember, the only way to lose money is to miss the recovery. It's not the time to bottom. But if you miss the recovery, then you've actually lost money that you're probably not going to get back. And discipline is the discipline to stick to your plan. So you got to stick to it. And it's, successful investing is all goal oriented. It's not market oriented. It's goal oriented based on your plan. And it's your financial plan that achieves your life, and it gives you the long-term perspective to make smart decisions. So now I love this quote by JP Morgan. A bear market is a period of time during which common stocks are returned to their rightful owners. So you can have the right mindset and be the rightful owner of the investments that you have. All right, so thank you for listening to my video. So my name is Ed Rempel. My blog, Unconventional Wisdom, is the #1 blog in Canada for a financial planner. It's unconventionalwisdom.ca, or it's just my name, edrempel.com. So unconventionalwisdom.ca, because we're in Canada. So now we have a financial planning practice, and we help growth-focused Canadians achieve the life that they want. If you like this video, please like and subscribe it, so that I'm trying to do a video or article every week. So if you subscribe, you'll actually get you'll get them regularly. Also, if you subscribe on my blog, then all you'll get from that is every article or video that I put out, I try to do one a week, will all be emailed directly to you. Thanks a lot for watching, and we'll see you next week.